Okay. So the lecture I will do today, after the invitation by Professor Gobbi, is titled From Efficient Market Theory to Behavioral Finance. So let's begin with a reflection on financial economics, understood as a branch of economics. As well known, economics is characterized by different approaches, and the dominant approach studies economic problems from the idea that they are reducible to a constrained choice problem. From this perspective, also financial economics may be defined in a framework of choice problem. Financial economics, we may read, for example, by a paper written by Edmund Cannan, concentrates on decision making when two considerations are important. The first one, some of the outcomes are risky. The second one, both the decision and the outcomes may occur at different times. So the subject is applied usually for investment decision, particularly in financial markets, such as the stock market, but it also has close links to the parts of microeconomics connected with insurance and savings. To the extent that financial assets are rights to future income flows staggered over time, most often in an uncertain manner, the objectivity of their valuation cannot be taken for granted. Indeed, what do we know about dividends from shares listed on the stock exchange today if we think about the future 10, 20, or 50 years from now? To answer this question, mainstream financial theory proposes to use a probabilistic scheme. So now I will present the mainstream financial economics tools in a very general way, and after we can enter into a new approach to finance that is named behavioral finance. But let me just anticipate a definition of behavioral finance proposed by Shiller, by Robert Shiller, in a very famous paper published in 2003 in the Journal of Economic Perspective. Behavioral finance is an approach to finance developed after the 70s that uses the psychology and sociology studies of the behavior of individuals and the underlying motivation to understand the anomalies that occur in the market of capital. This theory is based on the study of the behavior of investors in situations of uncertainty that lead the subject to make incorrect and not always rational choices. Okay, so there are just two relevant notes that we may stress. The first one is the fact that uncertainty in the perspective of behavioral finance is not treated as the same that the neoclassical financial economics does. And secondly, we have here the possibility to be outside rationality, at least in the same meaning in which rationality and rational choice is defined inside the neoclassical approach. But come back to mainstream financial economics, neoclassical financial economics. So in order to answer to the question that I considered before, what do we know about dividends from shares listed on a stock exchange today if we think about the future? We have to introduce the notion of fundamental or intrinsic value of a share in order to signal also the linkage between fundamental value and dividend. So the fundamental value of a share in this perspective is grounded in the flow of the future dividends that the possession of this share will provide for the owner. We set aside the question of discounting the value by assuming that it takes place at a constant rate that we made a note as R. Then this fundamental value can be written formally exactly by this series of discounted value, by discounting the value of the dividends at the time t+1, by considering just one time the rate R, the dividends in the following period t+2 by considering 2 times the constant rate R, and so on. So the fundamental value in a period t related to the future can be defined as the fundamental value which is calculated from the future dividends at dates, for example, t+n, which are denoted as dividend in t+n period. Okay,
Stefano,
so
they know very well the formula, and they know also that this formula converges as the value of the dividend is if the dividend are constant.
Perfect. What I want to underline is that the fact that in this way the future is described through a comprehensive list of world states understood as exogenous events. Once you specify the state of the world that we may define as E, okay, when you have this, you can calculate the dividend, and in this way, uncertainty is brought back to the probability with which a state of the world exogenously defined can occur. So shares will then be described by the payment they generate in each state of the world. So DE for every event E that belongs to a set capital E, where this is the complete set of the states of the world, is a way to treat the probability in an objective way. And the distribution laws referring to this random variable can then be established. Okay, so in a general model describing the markets where financial assets are traded, it is assumed that changes in payment related to each asset depend on a finite family of random variables. So the random variables, by assumption, in this approach, are observable and the distribution laws referring to them can be considered known or at least estimable. In a second step, investors on arbitrage skills are introduced. So this approach introduces profitable arbitrage opportunities that can be viewed as the simultaneous buying and selling of securities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. So in this way, we may also define expectation on the future state of the world in terms of rational expectation. And it is expressed mathematically thanks to the conditional expectation operator as a conditional mean that consider also the dividend in the future and the set of information that we may have in the period T, and this set of information is characterized by some very regular property. So by following the most famous neoclassical financial economist, Eugene Fama, we may define the concept of efficiency in financial markets by treating uncertainty in efficient way. So the problem of uncertainty is a problem of efficient information. And in an efficient market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. And this is the reason because neoclassical financial theory could be also described by the functioning of rational arbitrators, because they will buy on undervalued stocks and will sell on overvalued stock. And in this way, this rational behavior that is based on an objective way to forecast the value of the share by linking what happens on financial markets directly or indirectly on the real economy, we will have the possibility to explain the cycles that we may have on financial markets without rejecting the idea of rational expectation. One of the most famous example in this framework was introduced in 1953 by analyzing a specific part of financial market, the currency market, or if you prefer, the exchange rate market. And this paper, written by the father of the so-called Chicago School, Milton Friedman, is a paper where Milton Friedman introduced a theory of stabilizing speculation. What is the idea? Here you have on the vertical axis the exchange rate of the dollar versus an abroad currency, and on the horizontal axis you will have the time. So as you may see, we have a cyclical trend about the exchange rate, but this cyclical trend is mean reverting around a natural exchange rate. That is the value of the currency in terms of other currency that respects exactly what happens in the real economy in terms of the value of the commodities that in a sense may be a mirror of the value of the currency. Okay, so what is the way to behave rationally in this framework? When you have an over-evaluation, so a valuation over the natural exchange rate, the agents will recognize, first of all, that this is a maximum over-evaluation, so they will be rational by selling the currency that is over-evaluated. In this way, you will have a depreciation of the currency. And again, if you will be on a minimum, for example, this maximum devaluation point, you will behave exactly in the contrary way. And in both the situation, what we have is the fact that the value of the currency that we may consider here a specific financial asset, the most liquid financial asset that we may imagine, the currency, will go towards its natural value, the natural exchange rate that reflect, in a sense, the fundamentals. So, what is strange in this theory, the theory of stabilizing speculation? First of all, we have a sort of hidden, very strong hypothesis. The first one is the fact that each individual engaged on the currency market will be characterized exactly by the same decision framework. So what we have generally when we see the currency market is that just some individual will consider a maximum point of overvaluation or a maximum point of devaluation a specific point. Generally, we will have that some people will start to sell or buy in a specific point and other people in another point. So we cannot observe a mean reverting of the cyclical trend around a natural exchange rate. Secondly, generally, when you have a maximum in terms of overvaluation or devaluation, you will not have an harmonic movement towards the hypothetical equilibrium, but you have but you will encounter a sort of run for selling or for buying. It will depend. So the movement will be not harmonious, but will be very fast, and this velocity, this in the market, generally will have as a consequence an instability of the other behaviors. And third, if you observe the financial market, you cannot have over the same time what here is defined by Friedman as natural. Okay, why? Because generally you will have a movement of this hypothetical natural exchange rate over the time. So in a specific period, you may have that the natural exchange rate may be considered as 1. In other period, it may last from a specific period in time to other period in time, but at the value, for example, of 0.9. In other period, you may see this sort of mean reverting trend that will last until until it will last. That may be, for example, at 1.1. So you cannot imagine to have a natural equilibrium, but just to anticipate a point, what you have generally on financial market is a conventional equilibrium. Okay, that is an equilibrium that may be defined by a conventional judgment. Okay, so let's consider now what behavioral finance introduce in the debate. First of all, we may consider the fact that behavioral finance represent a challenge, and a challenge against the neoclassical claim that arbitrage is the economic force able of curbing price drifts generated by the presence of irrational investors. So the central thesis of behavioral finance states that arbitrage is in reality is risky, hence it is limited. So financial rationality cannot be limited to the observation of the fundamentals alone. One of the most relevant research in the field of the financial economics that open towards the behavioral finance as an alternative to the neoclassical financial theory is represented by the paper written by Robert Shiller in 80s. And what is the starting point of Shiller? The starting point of Shiller is an analysis of the financial bubble. And financial bubble is defined and is measured by consider the volatility of financial market. Again, the volatility of financial market that cannot be reduced by introducing, or if you prefer, by forcing a specific definition of rationality in terms of rational expectation that may justify the stabilizing speculation, or if you prefer, that may justify the rational arbitrators that bring in buyers on undervalued stocks and sellers on overvalued stocks. So the point for Shiller is that the reality is characterized by a not harmonic trend, and a not harmonic trend around a natural value, a natural equilibrium. Robert Shiller will win in 2013 the Nobel Prize, and the motivation was the fact that he shows the weakness on the assumption that represent the main bricks of the neoclassical financial economics construction, that we may sum up in three assumptions. The first one: efficient market model is best conveyed through an expected present value model in which real discount rate is constant through time. Second, the discount rate corresponds to interest rates. And the third one, stock prices are the expected present value of the future dividend discounted using marginal rates of substitution of consumption. And here you have a blue line that represents the actual stock price in the United States from 1860 to 2013. You have a red line in which you have the price discounted with actual future interest rates, and another red line that is more continuous that represent the consumption discounted dividends. So the analysis of the forecasted prices based on consumption discounted dividends. And you have also a green line that represent what we obtain by applying our rational expectation based model of forecasting, in which we have the perfect foresight price and point based on the last 10 years dividend growth. What you have here, that you have that you cannot define stock prices, actual stock prices, as expected present value of the future dividends, discounted by following different procedures. Let me just quote a passage from the Robert Shiller Nobel lecture. The Robert Shiller Nobel lecture that you may find in the Nobel Prize website, and you may also see the discourse in 2013 during the celebration for the Nobel Prize by Shiller, and you may find it also in my YouTube channel, Alfred Wolf, and you will have a 30 minutes of the Robert Shiller lecture. But let me just quote some passages of the lecture. First of all, he wrote immediately, the Nobel lecture is titled Speculative Asset Prices. And he wrote, I would say that a speculative bubble is a peculiar kind of fad, of maniac behavior, of a fad, or social epidemic that is regularly seen in speculative markets, not a wild orgy of delusions, but a natural consequences of the principles of social psychology coupled with imperfect news media and information channels. In the second edition of my book, Irrational Exuberance, I offered a definition of bubble that I thought represents the term's best use. What is this definition? A situation in which news of price increases spurs investor enthusiasm, which spreads by psychological contagion from person to person, in the process amplifying stories that might justify the price increase and bringing in a larger and larger class of investors who, despite doubts about the real value of the investment, are drawn to it partly through envy of other successes and partly through a gambler's excitement. So this definition puts the epidemic nature, the emotions of investors, and the nature of the news and information media at the core of the bubble phenomenon. So, if we want to explain why we have this kind of not harmonic cyclical trend, we cannot find the motivation just in the future dividends discounting using, for example, actual future interest rate, or if you prefer, the marginal rates of substitution of consumption. And it is normal that this way to describe the forecasted prices of the shares is, as you may see in the figure, characterized by mistakes, because the distance between the actual stock prices line, the blue line, and the other line represent exactly the mistakes in the forecasted prices used the different procedure based on the neoclassical financial economics. What is the most relevant lack is the absence of the analysis of psychology and the absence of the analysis of heterogeneous agents. In a word, is a new need to treat uncertainty in a new way. And what may be the way to treat uncertainty? This will be the second part of my discourse, but let me just consider at the moment the way to measure the volatility in Shiller's perspective. In order to measure volatility, and in order to consider the necessary evolution of financial economics towards, by following Shiller and other scholars, the behavioral finance, we may introduce the so-called price-earnings ratio. What is the price-earning ratio? Is the ratio of a company's share price to the company's earning per share. And the ratio is used for valuing companies and to find out whether they are overvalued or undervalued. Okay. So in a sense, it could be a measure of the mistakes in forecasting. Okay. You have a specific representation of the future value of the economy on financial markets by considering share price. But you have a counter proof of this by considering the earnings per share. So the trend of this ratio will be a sign in order to measure a bubble and a burst of the bubble. And if you prefer, it's also a way to reflect regarding the euphoria on financial market when you have the birth of a bubble, when you have that share price over-represent earnings per share, or a proof of panic when you have exactly the contrary. And what is the situation by considering this kind of measure of volatility? By going from 81 to 2000. This is a graph that is also present in the Schiller's famous book, Irrational Exuberance, but it is also used by a relevant French scholar that proposed an interesting approach to finance, André Orléans. And André Orléans, as you may see, will show in this trend some date that are episode of financial crisis. In 1901, in 1901, in 1929, in 1966, and in 2000. Here we have exactly the price-earning ratio that is a way to measure this episode of volatility that are also a signal of some relevant historical episode of financial markets. And there's an interesting exercise related the excess volatility on financial market proposed by this French scholar. Here you have a table, and in this table you have a representation of the average annualized returns over 15 years. So you have here the most relevant index to measure the performances on financial markets in Europe, United Kingdom, in Germany, France, and Hong Kong financial markets. Here you have the name of the indices, and here you have the average annualized returns over the 50. And this is the average annualized returns. What we may see by considering only what is described on this column. We have that the performance are positive. And they are, in a sense, a good information about the about our savings if we will invest on the financial markets. But what happens? We missed the 10 best days of the index. Here you have that this miss will provoke a reduction of a decreasing of the performance. And what happens if you miss the 20 best days? Here you have that in two regional financial market, you will reach a a zero performance, a very near zero performance trend, just reducing on 15 years 20 days. And what happens if you miss the 30 best days? You will have for these three markets negative performance. Okay, and what happens if you miss the 40 best days on 15 years? Okay, that you will have negative results. So what we may derive from this table, that the good performance on financial markets over 15 years are conditioned by very specific episodes, very specific days. Generally, if we do not consider these very specific episodes, we will record negative trends. So, a consequence of this should be that the speculative motives cannot be considered as stabilizing. Remember that this was exactly the approach by Milton Friedman and the Chicago School, that it is at the origin of this approach to financial economics, the neoclassical approach to financial economics. And another consequence is the fact that generally what happens on financial markets will lead the performance of financial markets in a negative light. We will encounter negative performance. So at least on average, when we missed the very good days on financial markets, it is sufficient the 40 best days, we will record a negative trend of financial markets that is another proof of the autonomy of the financial markets compared to what happens on the real economy. Okay, have you any questions or notes about this? Lucio, do you want to add something about this point?
No, the students have read this paper, and therefore I think that if you have a question or something that was unclear in the Sarah explanation, no, fine.
Okay, what do you think about my explanation? Is it at the moment quite clear what I said? Lucio, is for you the question.
It's for me the question. Yes, I understood.
Okay. No, but is it quite clear?
Yes.
Okay. So the other step I would like to do is obviously what may be the necessary change in the roots of the theory that we have to build in order to study not only volatility but financial markets. And the first starting point could be a reflection about the most relevant law on economic theory. That is the supply-demand model. As you may see, when you have the an economics course in the handbook, you will have that the demand generally will be decreasing line, and the supply will be an increasing line. And this kind of equilibrium that we may obtain will be a very stable equilibrium, because in each point of the space you will have, for example, a situation in which the quantity that you are demanded will be excessive, and this will provoke a decreasing trend towards towards a reduction of the demanded quantity. And again, if you are, for example, in this space, you will have a higher price that is higher than the equilibrium price, and obviously you will have a natural movement towards the equilibrium that will provoke a convergent movement, and you will have this convergent movement convergent towards the equilibrium that is a demonstration. It's a graphical demonstration of the stability of this equilibrium. But what happens if just one of these line is not well behaved? For example, by considering the demand as an increasing line. Before answering, I would like just note that this is exactly the situation in financial markets. Why? Because consider a share, and consider that you investor, you financial investor, you are observing an increasing price of the share you have. What will be your rational behavior? Your rational behavior will be buying new shares. Why? Because you are expecting that the increasing trend of the market will last over time. So when you have an increasing price in the neoclassical world, that if you want, maybe consider what happens in some commodities market, the markets for the commodities that we buy when we go to the supermarket. You will have that our demand will increase when the price will be decreasing. But in financial markets, it is exactly the contrary. So the demand generally will be increasing, an increasing line. But if the demand is an increasing line, the characteristics of the equilibrium between demand and supply will be different, because the analysis of the stability condition of the equilibrium will lead to an unstable equilibrium. And this is, in a sense, if not a complete microfoundation, we may consider it as a contribution for understanding at the micro level the behavior of individuals on financial markets. And it is the behavior of the individuals on financial market that may explain the instability on financial markets, that will be also a motivation for the volatility of financial markets. Okay, but
Stefano, you have 15 minutes.
Yes, yes, no problems. When you have a deepening study on behavioral finance, you will encounter two family of models that lead towards very intriguing results. These two family of models are defined in the 2003 paper by Robert Shiller as feedback models and as smart money versus ordinary investors. Let me conclude my lecture by introducing you just two interesting results that today may be considered as the starting point for developing the behavioral finance paradigm. The first one is a paper written in 1988 by Vernon Smith, Gary Suchanen, and Arlington Williams. It is an experiment. The title, as you may see, is Bubbles, Crashes, and Endogenous Expectation in Experimental Spot Asset Markets. Here you have the abstract, but let me just explain you the core of the paper. The authors study how the price of a financial asset whose life lasts 15 or 30 periods varies on this time. In each period, holding the asset entitles the holder to a dividend D, and the law of probability is common knowledge. So you have a situation of a possible perfect forecast, and common knowledge is ED. So the experimenter, so if you the master of the game, makes public the fact that at the end of the game, the stock back at some value V. So the value V is the certain value that you may refer to the owning of the asset. At each instant, every gamer, every player may compute the fundamental value of the considered stock, because this will depend on the number of periods left to play before the end of the game. Okay, and this is the formula that you may imagine. And what is the observations by this scholar that have organized this experiment? In the vast majority of cases, at the beginning of the game, the price moves slightly away from the fundamental value that here in this war, in this experiment, in this game, may be computed with perfect knowledge, and then rises very high, very beyond the fundamental value. It reaches a kind of upper limit, and toward the end of the game, so when you know that the end is near, notes a brutal lowering that brings its course back to the level of the fundamental value. So you have also, in a situation in which every agent may compute the fundamental value, and every agent at the end of the game may receive a precious gain, that there's a a bubble. There is the succession of an upward bubble followed by a crack, with between the two a phase of flat calm. So what is the real and relevant result of this experiment? That even under such favorable conditions, the emergence of bubbles is observed. So what may be the reason of the bubble? They are psychological reason. There's a sort of human behaviors that depend on other kind of motivation. Second result that is in the field of the smart money versus ordinary investors models. Here the paper was published in 1990 on the Journal of Political Economy. The authors are Brad DeLong, Andrei Schleifer, Larry Summers, and Robert Woolman, and the title is Noise, Trade, and Risk in Financial Markets. It is a model, it is not an experiment, and the assumption is that investors, the main assumption is that investors are not fully rational, and that arbitrage is risky. Then the market chooses to be efficient, and we have heterogeneity in the agents in a model in which we have two periods. Rational investors face positive feedback traders. So you have ordinary investors versus smart money, and the positive feedback traders buy when they observe an upward trend and sell in the opposite case. Okay, so they follow, in a sense, an increasing demand on the market, as the one I showed you before. So what is the result of the model? And is that the presence of rational agents is destabilizing. That's very interesting. Rationality is not necessarily stabilizing. Why? Because the rational agents, in order to maximize their profits in the period Q, have an interest in stimulating in the previous period the errors, the valuation errors of the other agents, the positive feedback one. So the capital gains pocketed by rational investors are a function of the difference between fundamental value and the mistakes done by the positive feedback trace. So the phenomena of financial bubbles cannot be, and this is the reason because Andrea Orlean is not satisfying just with the Robert Shiller way to do research in behavioral finance. The phenomena of financial bubbles cannot be thought as an irrational episode characterized by an accidental misalignment between price and intrinsic value. They are the result of a polarization of collective beliefs around a common representation of the future, which is called the dominant valuation convention, or if you prefer, a dominant valuation conventional judgment. Similarly, a stock market crisis can no longer be analyzed as a speculative bubble that has suddenly burst and the return to true values, but as a sort of bifurcation of the collective beliefs, a reversal of the dominant valuation convention. But this interpretation is derived by starting on results that are obtained inside the research approach of behavioral finance. Obviously, what is in the back of this lecture is the John Maynard Keynes thought and especially the part of the general theory in which John Maynard Keynes introduced the so-called beauty contest. The beauty contest where participants are asked to choose the 6 most beautiful faces of pretty girl from 100 photographs in a magazine, and the prize would go to the contestant whose choices came closest to the average preference. What is the way to win in this world is not choosing the prettiest girls, the 6 prettiest girls, in my opinion, but what I think the average think are the 6 prettiest faces. And in a sense, we may also correct again this way to choose, because what is the best decision process is to choose what the average think that the average think are the 6 prettiest girls on the pictures. And of course, this will open the floor to an interdisciplinary approach of the problem of financial markets. The other notion that I'm quite sure that Lucio Gobbi introduced you and that are emerging by this lecture is the linkage between uncertain knowledge and the conventional judgment. Here,
Stefano, we have done the differences between uncertainty and risk, and we play a simplified version of the beauty contest game. So the student yes, they know this kind of topics. You can conclude?
Yes, we are concluding by recalling this experience that your students lived. So they lived an experience of psychology of a society of individuals, each of whom is endeavoring to copy the others. And this is the real nature of conventional judgment. What I want to just say before the conclusion is a question. Okay, why this research program is relevant for policy? What are the policy implications? Let me just pose this question. What happens if the role of financial markets becomes central in our economy? So what happens if collective savings are drained from the stock exchanges and if the financing of the economy shifts from the banking sector to the stock market sector? The answer is that the central bank in this situation could be forced to accommodate the demand for liquidity from gradually increasing debt position. And it happens that the money certified by central bank, that is a sort of absolute liquidity, support the reliance on publicly traded security, the elected to near money, to derivative liquidity. And this is the reason because what we called conventional judgment should be in a sense regulated, should be in a sense also one of the aim of a central bank. Thank you very much for your attention.
Thank you very much, Stefano. Student has some question.